Hey guys, today we're talking about leveraging versus being debt-free. It's something that most people struggle with. You're borrowing to invest. Does it make sense? Are you going to make more in the investment world than you're paying off in your interest? A lot of people struggle with this, and we're going to cover it today. We do this all the time, folks. We advise people on stuff like this. We advise people on leveraging specifically and whether or not they should do it and how they should do it. If it's on your mind, if it's something you want to talk about, please go to speaktorob.com. We'll book a no obligation free consultation call, and then you and I can sit down and we can give you some peace of mind about that. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group here at Canaccord Genuity Wealth Management. Before I get into the video, please take a second and subscribe. We'd love to hear your comments as well. If you have some comments about the video, give us a like, give us a share. Today we're talking about leveraging, okay? So leveraging is borrowing to invest. The traditional form of leveraging is the form that most people do the first time they buy a house. They end up borrowing to invest in their home. You're buying a $500,000 home, you don't have a $500,000, you borrow, you have maybe $100,000, you put down as a down payment, you leverage the other $400,000. That's the first form of leveraging that most people do. The other form of leveraging that we're talking about today is leveraging with your investments. So you borrow to invest. So let's talk about a margin account first of all. So a margin account is a non-registered investment account. So it's not an RRSP, it's not a TFSA, it's a margin account. You can borrow on the margin that is available on your securities. Pretty much every investment firm will allow you to do this. Interest rates will vary, but you could be as low as prime plus a bit. You could be as high as prime plus a lot, depending on the institution, depending on the amount of leverage that you have. So let's assume you got a list of securities. The Securities Commission gives us rules, and there are compliance rules with respect to how much we can lend off of each security, depending on the price of the security. Some securities are as high as 70%. So you have $1 worth of security, or let's call it $100 worth of security, you could lend up to $70 on that $100. Every day, these shares are marked to market, and if the value of the loan is higher than 70%, you get what's called a margin call. Maybe you've seen a movie about this. Maybe you've heard of friends losing their entire portfolio. It's not a pleasant situation, and many people have been wiped out over time due to margin calls, because what ends up happening is you kind of start to get wiped out in a declining market. Every day, your shares are worth less, therefore your loan is worth less, but your loan amount hasn't moved. So you need to either put cash into the account or you need to sell securities. If people don't have the cash, they start selling securities. The next day, the market's down. This spreads more selling. More selling means lower prices. The stock market's falling. People are getting margin calls and selling securities, and eventually there's nothing left in the portfolio. It happened quite a bit in the 80s. 2008, there were people wiped out by these margin calls, and it's something that most people don't understand and don't appreciate how it works. By the way, if this is something that's on your mind or this has happened to you, go to speaktorob.com. We'd be happy to book a call to chat about that type of margin investing. So if you're going to be doing leveraging on investing through a margin account, first of all, you need to understand how it works. You need to understand margin calls in and out. You need to understand the value of the loan. You need to understand the volatility that will happen. The word leverage comes from the French word levier, or the English word lever, which means you're amplifying the returns and you're amplifying the losses. So think of a lever, a teeter-totter that's moving a little bit and the other side kind of goes a ton. So if you do have leverage, every percent that you gain, the more leverage you have, you're going to gain even more, and every percent you lose, you're going to lose more. So it's basically amping up your portfolio returns one way or the other. You need to understand how that works. You need to understand how the tax implications of it are, and you need to understand the volatility, and you need to know for a fact that you're able to stomach it. Most people, they can't do it. The vast majority of people can't do it, but if you can, if you've done it before, you've experienced and you don't know how it works, and you want to do it, all right, we could talk to you and we could figure out a way to do it. Through a margin account, what we would suggest, typically a prudent strategy would be, if you are leveraging and you understand it, you know how it works, you're leveraging up as the market falls and you're leveraging down as the market goes up. So the market's falling, and maybe every 5% that the market falls during a correction, you would increase your leverage. That would be a strategy that some would think would be an optimal way to take advantage of the fact that the market's correcting. You could borrow money for relatively cheap these days, and you can hope to make more than that with your investments. The neat thing about borrowing on margin like that is that that is a tax-deductible expense for you. So if you are a top tax bracket, high net worth individual, that becomes a tax write-off for you. So the markets are falling, you are adding to your investment portfolio a little bit at a time. You should set some limits. You should talk to your advisor, make sure you have limits in your mind as to the maximum amount that you'll ever be leveraged. I would strongly advise that you not go close to the 70% mark unless you have a ton of cash flow that you can fund your account if you do get a cash call. So that's a traditional margin account, okay? The other account that we want to talk about is other ways to leverage. So people do this all the time and have come to me and asked me, how do I leverage my home? How do I leverage my cottage? So those are real assets. Now, most people are talking to us about being debt-free. They want to be debt-free. They want to pay down their debt as quickly as they can. Now, this becomes effectively a risk-reward scenario if you're willing to pay down your debt fast or if you want to continue to have the leverage and build your investment portfolio. Paying down your debt fast would be something that would be a peace of mind decision. You want a peace of mind. You don't like having debt. You want to have it off the books. And once you're debt-free, you're debt-free for life. This is how the majority of people think. I would imagine the people that we talk to, that's what they say. Now, if you're of the view that you want to borrow off an asset, one way you could do it would be through a HELOC, a home equity line of credit. So a HELOC is an investment. Basically, it's an account that's tied to the value of your home that you can draw on. Every time money goes into the account, you now have available margin room. You can take that money out and you can put it in your investment account if you'd like. So every time money goes in, you now have available margin room. So your paycheck goes into the same account and then your expenses come out of the same account. And if you would do it that way, most people would kind of be leveraged at the same number for a while with the goal of funding an investment account on the side. The math is pretty simple. You're paying 3 or 4% on your home equity line, whatever the number is. Are you going to make that number with your investments? If you think you're going to make at least that number with your investments, the math makes sense. The question is, can you handle it? Can you handle the volatility, and can you handle the fact that you're not going to be debt-free? That's a personal question. We'd love to chat with you about that. It's something that we could take a look at. Another way to do it is, let's say you get a windfall. So you have a mortgage, you get a windfall either through an inheritance, either through the sale of a business, or you get some sort of cash windfall, a lottery, whatever it may be. One way to effectively reduce your cost of borrowing and increase your leverage while increasing your return would be you take that windfall, you pay down your mortgage. So it goes to zero. Then you borrow either through a conventional mortgage or through a HELOC, and then you could place that into the market. Then that becomes tax deductible because you are borrowing to invest, and that would be another form of leverage, being leveraged. So you could do the HELOC, you could do the traditional mortgage. The traditional mortgage pay down that I just called is a kind of a modified Smith maneuver, and that allows you to write off the interest. Additionally, you could do it through your margin account, or if you're really, really gutsy, you can do it in all of them. You could leverage on top of leverage on top of leverage. Please make absolutely sure to talk to your advisor before you do that, because it's not something for the faint of heart. A lot of volatility, and you got to understand the consequences of that. Additionally, in the market now, there are forms of leveraged ETFs that exist, so you can get a double or a quadruple ETF that goes one way or another based on what happens in the market. Again, those are not for the faint of heart. Those are short trades only, and you really need to understand how they work if you're ever going to do one. Make sure to talk to your advisor about that, but that is an option that exists. So margin account is something that some people do to take advantage of market corrections as they kind of move down or as they move up. Effective way to kind of grow your net worth if it's something you understand and you appreciate. The HELOC and the traditional mortgage are ways that you can reduce your cost of borrowing and write off the interest through your margin account and typically pay a little less than you would in a margin account. And those are all ways that you can leverage, and something that if you're doing, give us a call. We'd love to chat with you about that. My name is Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group here at Canaccord Genuity Wealth Management. Again, take a moment to subscribe, and if you have a moment, go to speaktorob.com. We'd love to hear from you. Thanks. Have a great day.